Hello guys, today we are talking about the top 5 smart investments in a shaky economy. Have you ever felt that sinking feeling when you check your investment portfolio during market turbulence? That moment when you see red numbers across the screen and wonder if you've made the right choices with your hard-earned money? You're not alone. In today's increasingly unpredictable economic landscape, finding safe havens for your investments has become more challenging than ever before. But here's the good news: uncertain times don't have to mean uncertain returns. The global economy is sending mixed signals right now. Inflation concerns, geopolitical tensions, and lingering supply chain disruptions are creating a perfect storm of market volatility. But I'm here to tell you that volatility doesn't necessarily spell disaster, it spells opportunity for the prepared investor. And that's exactly what we're going to talk about today: the top 5 smart investments that can not only weather a shaky economy but potentially thrive in it. Now, before we dive in, I want to make something clear. I'm not promising get-rich-quick schemes or magical money-making secrets. What I am offering is a thoughtful analysis of investment options that have historically shown resilience during economic downturns, along with some emerging opportunities that deserve your attention. Let's start with perhaps the most classic safe haven investment: gold. For thousands of years, this precious metal has been the go-to asset during times of uncertainty. And there's a good reason for that. When inflation rises, when currencies fluctuate, when stock markets tumble, gold often maintains or even increases its value. Just look at the data. During the 2008 financial crisis, while the S&P 500 plummeted by about 38%, gold prices increased by nearly 5%. And during the COVID-19 market crash in early 2020, gold again demonstrated its resilience, quickly rebounding and reaching all-time highs later that year. But here's the thing about gold that many people misunderstand: it's not just about buying physical gold bars or coins and stashing them under your mattress. Today, there are multiple ways to add gold exposure to your portfolio. Gold ETFs like GLD or IAU offer a convenient way to invest without the hassle of physical storage. Gold mining stocks provide a leveraged play on gold prices, potentially amplifying returns when gold rises. And for those who do prefer physical gold, there are now secure storage solutions that eliminate the risks of keeping valuable assets at home. That said, gold isn't without its drawbacks. It doesn't generate income like dividend stocks or bonds. Its value can stagnate for long periods, especially during strong bull markets in equities. And it's subject to price manipulation and speculation. That's why I always recommend gold as one part of a diversified portfolio, not as your entire investment strategy. Now, let's move to our second smart investment option: defensive dividend stocks. Not all stocks are created equal when it comes to weathering economic storms. Companies in sectors like utilities, consumer staples, and healthcare often continue to generate stable cash flows even during recessions. Why? Because people need electricity, food, and medical care regardless of economic conditions. Take a company like Procter & Gamble, for example. They make everyday essentials: toothpaste, laundry detergent, diapers, products that people continue to buy even when tightening their belts. P&G has increased its dividend for 66 consecutive years, including through multiple recessions and market crashes. That kind of stability is invaluable during uncertain times. Or consider healthcare giants like Johnson & Johnson. People don't stop needing medications or medical devices during economic downturns. These companies often maintain relatively stable revenues and continue paying dividends even when the broader market struggles. What makes defensive dividend stocks particularly attractive in today's environment is their dual benefit: they offer relative price stability compared to growth stocks during market turbulence. Plus, they provide income through dividends, something especially valuable when many fixed-income investments are still yielding less than inflation. But here's my word of caution: even defensive stocks aren't immune to market downturns. They can still decline in value, sometimes significantly. The key difference is that they typically fall less than the broader market and recover faster. And those dividends keep coming, allowing you to reinvest at lower prices, essentially buying more shares when they are on sale. When building a defensive dividend portfolio, I recommend focusing on companies with a few key characteristics: a history of dividend increases, manageable debt levels, strong free cash flow, and products or services that remain essential regardless of economic conditions. It's not just about chasing the highest yields. Sometimes an extremely high dividend yield can signal a company in trouble. Instead, look for sustainable yields backed by solid business fundamentals. A third investment category worth considering in today's environment is short to intermediate-term bonds and bond funds. Now, I know what you might be thinking: aren't rising interest rates bad for bonds? And you'd be partly right. When interest rates rise, existing bond prices typically fall. But this effect is most pronounced for long-term bonds. Shorter-term bonds are less sensitive to interest rate changes and provide more flexibility as they mature more quickly, allowing you to reinvest at potentially higher rates. Treasury inflation-protected securities, or TIPS, deserve special mention here. Unlike regular government bonds, TIPS adjust both their principal value and interest payments based on changes in the Consumer Price Index. This built-in inflation protection makes them uniquely suited for periods of rising prices, exactly what we've been experiencing lately. I'm particularly interested in I-bonds right now, a type of savings bond issued by the U.S. government that combines a fixed rate with an inflation adjustment. While there are purchase limits and holding period requirements, the inflation-adjusted returns have been substantial recently compared to traditional savings accounts or CDs. For many investors, accessing these bond investments through low-cost ETFs or mutual funds makes the most sense. Funds like VTIP, Vanguard Short-Term Inflation-Protected Securities ETF, or STIP, iShares 0 to 5-year TIPS Bond ETF, offer diversified exposure to inflation-protected government bonds with the ease of stock trading. What I appreciate about the bond portion of a portfolio is that it serves multiple purposes. It can provide income, reduce overall portfolio volatility, and offer a source of funds for rebalancing or opportunistic buying during market downturns. Think of it as the shock absorber for your investment vehicle as you navigate the bumpy road of market volatility. Now we've covered three traditional safe havens for turbulent times: gold, defensive dividend stocks, and strategic bond investments. But the investment landscape has evolved, and some newer options deserve consideration in today's unique economic environment. In our next discussion, we'll explore two more potentially smart investments that might surprise you, including one asset class that was barely on investors' radar a decade ago but now commands serious attention from both individual and institutional investors. I'll also share a framework for determining the right allocation across these 5 investment options based on your personal time horizon, risk tolerance, and financial goals. Because ultimately, the best investment strategy isn't universal, it's the one tailored to your specific situation and that you can stick with through market ups and downs. So stay with me as we continue this journey through the investment landscape of a shaky economy. So we've already explored how gold, defensive dividend stocks, and strategic bond investments can help protect and potentially grow your wealth during uncertain economic times. But the investment landscape is constantly evolving, and today I want to introduce you to 2 more compelling options that might not be as traditional but deserve serious consideration in your portfolio. Let's talk about our 4th smart investment, real estate investment trusts, or REITs. Now, I know what you might be thinking: real estate during economic uncertainty? And that's a fair question. Traditional real estate investments often require substantial capital, involve significant management headaches, and can be highly illiquid, not ideal characteristics during market turbulence. But REITs offer a completely different approach to real estate investing. REITs are companies that own, operate, or finance income-producing real estate across various sectors, from apartment buildings and shopping centers to data centers and healthcare facilities. They're required by law to distribute at least 90% of their taxable income to shareholders as dividends, which often results in above-average dividend yields compared to the broader market. And the best part? You can buy and sell REIT shares just like stocks, with none of the hassles of direct property ownership. What makes REITs particularly interesting in today's environment is their potential as an inflation hedge. Think about it. As inflation pushes up the replacement cost of buildings and land, existing real estate often becomes more valuable. Many REITs also have the ability to raise rents as inflation increases, especially those with shorter-term leases like apartment or self-storage REITs. This can translate to growing cash flows and dividends over time. But not all REITs are created equal, especially during economic uncertainty. I tend to favor REITs in sectors with strong demand fundamentals and some insulation from economic cycles. Data center REITs like Digital Realty Trust or Equinix benefit from the unstoppable growth in cloud computing and digital transformation. Healthcare REITs like Welltower or HealthPeak Properties serve the needs of an aging population, a demographic trend that continues regardless of economic conditions. And infrastructure REITs that own cell towers or energy pipelines provide essential services with long-term contracted revenue streams. That said, REITs do come with risks. Rising interest rates can create headwinds as they increase borrowing costs and make the yields on other investments more competitive. Some retail and office REITs face secular challenges from e-commerce and remote work trends. And during severe market downturns, REITs can sometimes experience significant price volatility, even if their underlying property values and cash flows remain relatively stable. My approach is to focus on quality, REITs with strong balance sheets, sustainable payout ratios, and properties in growing markets. I also prefer REITs with management teams that have successfully navigated previous economic downturns. These factors won't eliminate volatility, but they can help ensure your REIT investments emerge stronger on the other side of economic turbulence. Now let's move on to our fifth smart investment option, and this one might surprise you. It's you. Yes, I'm talking about investing in yourself and your own skills. In an increasingly automated world where job security isn't what it once was, your knowledge, skills, and adaptability are perhaps your most valuable assets. And unlike market investments, the returns on self-investment are largely uncorrelated with economic cycles. Think about it this way: when you invest in developing a valuable skill set or expanding your knowledge base, you're essentially creating a personal asset that can generate returns throughout your lifetime. These returns come in various forms: higher earning potential, greater career stability, and the ability to pivot when economic conditions change. Consider the example of someone who invested time and money in learning digital marketing skills 5 years ago. As businesses increasingly shifted online, especially during the pandemic, those skills became incredibly valuable. While many traditional jobs disappeared overnight, digital marketers found themselves in higher demand than ever. That's the power of investing in future-proof skills. What kind of self-investment makes sense right now? I believe there are a few particularly promising areas. First, data literacy, the ability to understand, analyze, and communicate with data. As businesses generate ever-increasing amounts of information, people who can extract meaningful insights from that data will remain valuable regardless of economic conditions. Second, digital creation skills, whether it's video production, podcast creation, graphic design, or coding. The creator economy continues to grow, offering both primary and secondary income opportunities that can provide financial stability during economic uncertainty. Third, what I call human skills, things like emotional intelligence, communication, negotiation, and leadership. As automation handles more routine tasks, these distinctly human capabilities become even more valuable. And they're transferable across industries, giving you flexibility during economic shifts. The best part about investing in yourself is that the potential return is uncapped, and unlike market investments, you have direct control over the outcome. No market crash can erase the skills you've developed or the knowledge you've acquired. Of course, self-investment requires resources, both time and often money. But there are more affordable options than ever before. Online platforms like Coursera, edX, and LinkedIn Learning offer high-quality courses at a fraction of traditional education costs. Industry-specific certifications can provide credibility without a full degree program. And the explosion of content on YouTube, podcasts, and blogs means valuable knowledge is often available for free if you're willing to curate carefully and put in the work to apply what you learn. Now, let's talk about how to combine these 5 investment strategies: gold, defensive dividend stocks, strategic bonds, REITs, and self-investment, into a cohesive portfolio that makes sense for your situation. Because the right mix isn't universal, it depends on your age, financial goals, risk tolerance, and time horizon. If you're younger with decades until retirement, you might weight your portfolio more heavily toward dividend growth stocks and REITs, with smaller allocations to gold and bonds. Your biggest investment might be in developing marketable skills that can increase your earning potential for years to come. If you're closer to retirement, safety becomes more important. A higher allocation to bonds, especially TIPS, can provide income and stability. Gold might play a larger role as portfolio insurance. And your dividend stocks might tilt more toward established companies with long histories of dividend increases rather than those with the highest growth potential. Regardless of your age, economic uncertainty calls for diversification, not just across these 5 categories, but within them as well. For example, within your defensive dividend stock allocation, consider spreading investments across multiple sectors like utilities, healthcare, consumer staples, and telecommunications. Within your REIT exposure, include different property types rather than concentrating in a single sector. Another strategy to consider during uncertain times is dollar-cost averaging, investing fixed amounts at regular intervals rather than trying to time the market with large lump sums. This approach takes emotion out of the equation and ensures you're buying more shares when prices are lower and fewer shares when prices are higher. I also recommend keeping some dry powder, cash or cash equivalents that can be deployed quickly when opportunities arise. Market volatility often creates temporary dislocations where quality assets become available at bargain prices. Having the liquidity to take advantage of these opportunities can significantly enhance long-term returns. One approach I particularly like is what I call the barbell strategy, combining very safe investments at one end of the spectrum with calculated higher risk, higher reward investments at the other, while minimizing exposure to the middle. For example, you might hold high-quality government bonds and some physical gold as your safety anchors, while also maintaining positions in carefully selected growth companies with strong competitive advantages that could thrive despite economic headwinds. This barbell approach acknowledges a fundamental truth about investing during uncertainty: we can't predict exactly how economic conditions will unfold, so we prepare for multiple scenarios rather than betting everything on a single forecast. The safe end of your barbell protects you if conditions deteriorate further, while the growth-oriented end positions you to benefit if markets recover more quickly than expected. What about cryptocurrencies? I know many of you are wondering whether Bitcoin or other digital assets deserve a place in your portfolio during economic uncertainty. This is undoubtedly one of the most polarizing topics in finance today. Proponents argue that Bitcoin in particular serves as digital gold, a store of value with a fixed supply that can't be debased by central bank policies. Critics point to extreme volatility, regulatory uncertainty, and the lack of intrinsic value or cash flows. My take? For most investors, any cryptocurrency exposure should be limited to a small percentage of your overall portfolio, an amount you could afford to lose without jeopardizing your financial goals. If you do venture into this space, focus on the more established cryptocurrencies with broader adoption and stronger network effects, and be prepared for a wild ride. Remember that historically, truly revolutionary technologies and asset classes typically experience multiple boom-bust cycles before finding their long-term equilibrium. The internet stocks of the late 1990s went through a massive bubble and crash before the technology ultimately transformed our world. Cryptocurrencies and blockchain technology may follow a similar pattern, with enormous volatility along the way. As we move forward to our final set of investment strategies, I want to emphasize something important. Investment success during uncertain times isn't just about picking the right assets. It's about maintaining the right mindset. Fear and greed are powerful emotions that can overwhelm rational decision-making, especially when headlines are screaming about market crashes or inflation spikes. Developing systems and rules for your investing approach can help counter these emotional responses. Whether it's a regular portfolio rebalancing schedule, predetermined criteria for when to buy or sell certain assets, or simply a commitment to review your investment thesis before making any moves, These guardrails can prevent costly mistakes during market turbulence. Now that we've covered 4 solid investment strategies for navigating economic uncertainty, let's round out our discussion with one final approach that deserves serious consideration: alternative investments. I'm talking about assets that don't fit neatly into traditional categories like stocks, bonds, or cash, things like commodities, private equity, venture capital, and specialized funds that can provide both diversification and unique return opportunities. Let's start with commodities beyond just gold. While gold often gets the spotlight during economic uncertainty, other commodities can also shine when inflation runs hot or supply chains get disrupted. Take agricultural commodities, for instance. People need to eat regardless of economic conditions, and with global population growth continuing alongside climate change impacts on farming, agricultural commodities like soybeans, wheat, and corn may see sustained demand and price appreciation over time. Industrial metals like copper deserve attention too. Often called Dr. Copper because of its ability to predict economic trends, this versatile metal is essential for everything from construction to electronics. But what makes copper particularly interesting right now is its critical role in the green energy transition. Electric vehicles require about 4 times more copper than traditional cars. Wind turbines, solar panels, and the grid infrastructure needed to support renewable energy all demand significant copper. This creates a potential long-term demand driver that transcends short-term economic cycles. For most individual investors, gaining exposure to commodities through ETFs makes the most sense. Funds like PDBC or DBC offer broad commodity exposure without the complexities of futures contracts or physical storage. More targeted funds like CPER for copper or corn for agricultural commodities allow you to focus on specific areas where you have stronger conviction. Beyond commodities, alternative investment funds that employ strategies uncorrelated with traditional markets merit consideration. Market-neutral funds, for example, aim to deliver positive returns regardless of whether the broader market rises or falls by balancing long and short positions. While these typically won't match the returns of a strong bull market, they can provide valuable stability when markets turn south. Similarly, managed futures funds, which take positions in futures contracts across various asset classes based on price trends, have historically performed well during periods of sustained market stress. They can capitalize on downtrends in stocks or bonds while also benefiting from uptrends in commodities or currencies. These strategies tend to shine precisely when traditional portfolios struggle the most. Now, I recognize that many alternative investments have traditionally been available only to accredited investors or institutions. But that's changing. Today, there are publicly traded vehicles like interval funds and certain ETFs that provide access to alternative strategies with lower investment minimums and greater liquidity than in the past. Funds like BTAL, which provides exposure to a market-neutral strategy, or DBMF, which replicates managed futures strategies, are accessible to retail investors through standard brokerage accounts. One word of caution about alternatives: they often come with higher fees than traditional investments. This fee drag can significantly impact returns over time, so it's crucial to evaluate whether the diversification benefits and return potential justify the costs. I recommend being highly selective, focusing on alternatives with reasonable fee structures and proven track records across different market environments. Let's zoom out now and talk about how to integrate all these investment approaches into a coherent strategy that makes sense for your personal situation. Because ultimately, the best portfolio isn't universal, it's the one that aligns with your goals, time horizon, and risk tolerance while letting you sleep at night during market turbulence. I find that a useful framework is the core satellite approach to portfolio construction. Your core holdings, which might comprise 60 to 80% of your portfolio, consist of broadly diversified, lower-cost investments across major asset classes. This could include index funds or ETFs for U.S. and international stocks, bond funds aligned with your time horizon, and perhaps a REIT index fund for real estate exposure. Around this core, you position satellite holdings, more targeted investments in areas where you have stronger conviction or that provide specific benefits like inflation protection. This is where you might include your gold allocation, specific commodity exposures, alternative strategy funds, or individual stocks in sectors you believe will outperform during economic uncertainty. This approach gives you the best of both worlds. Broad market exposure through your core holdings ensures you don't miss out on general market returns, while your satellite positions allow you to express specific views and potentially enhance returns or reduce risk. For those of you wondering about specific allocation percentages, I generally recommend that gold comprise no more than 5 to 10% of a total portfolio. It's insurance, not a primary growth driver. Defensive dividend stocks might make up 20 to 30% of your equity allocation, with the specific percentage increasing as you get closer to retirement. For bonds, focus on the shorter end of the duration spectrum in rising rate environments, with tips comprising perhaps a quarter to a third of your fixed income allocation when inflation concerns are elevated. Alternative investments, including REITs, commodities, and strategy funds, might collectively account for 10 to 20% of a portfolio, depending on your access, understanding, and comfort level with these approaches. And remember that your most valuable investment, in your own skills and capabilities, doesn't show up on your brokerage statement but may ultimately generate the highest return of all. What about timing? Should you implement all these changes at once or gradually shift your portfolio? My experience suggests that dramatic portfolio overhauls rarely end well. Markets have a funny way of humbling investors who make large, concentrated bets based on macroeconomic forecasts, even when those forecasts seem obvious. Instead, consider a methodical transition using dollar-cost averaging to build positions in new assets over time. This reduces the risk of unfortunate timing and gives you the opportunity to learn about unfamiliar investments as you gradually increase your exposure. I also want to acknowledge something important. Investment strategies for uncertain times don't exist in a vacuum. They work best when integrated with broader financial planning. Having an appropriate emergency fund, managing debt levels, maintaining adequate insurance coverage, and ensuring your income sources are relatively stable, these fundamental financial pillars are just as important as your investment choices, perhaps even more so. For example, if you're carrying high-interest credit card debt, paying that down will likely provide a better risk-adjusted return than any investment strategy I've discussed today. If your emergency fund is inadequate, building that cushion should take priority over implementing sophisticated investment approaches. And if your income is highly correlated with economic cycles, you might want to be more conservative with your investment portfolio than someone with a more recession-resistant job. As we wrap up our discussion, I want to emphasize that economic uncertainty, while challenging, also creates opportunity. Asset price dislocations during periods of stress often plant the seeds for strong future returns. Those who maintain a long-term perspective, stay disciplined with their investment approach, and keep emotions in check tend to not just survive but thrive through market turbulence. Remember too that market timing is exceedingly difficult, even for professional investors. Trying to perfectly call market tops and bottoms is a fool's errand that typically leads to being out of the market during crucial recovery periods. Instead, focus on building an all-weather portfolio that can withstand different economic scenarios while still participating in long-term growth. I also encourage you to revisit your investment strategy regularly, but not too frequently. Quarterly reviews are typically sufficient, with perhaps more comprehensive reassessments annually or when significant life events occur. This provides the right balance between vigilance and the distance needed to avoid reactive decisions based on short-term market noise. Let me leave you with this thought. Throughout history, markets have faced countless crises, world wars, pandemics, financial collapses, political upheavals, yet the long-term trajectory has been upward. Companies innovate, adapt, and find ways to create value even in challenging circumstances. Economies evolve and ultimately grow. Patient, thoughtful investors who recognize this fundamental resilience have been rewarded time and again. So while today's economic landscape certainly presents challenges, I remain optimistic about the opportunities it creates for prepared investors. The 5 strategies we've discussed, gold and precious metals, defensive dividend stocks, strategic bond allocations, real estate investment trusts, and alternative investments, provide a robust toolkit for navigating whatever comes next. Complemented by perhaps the most important investment of all, developing your own knowledge and skills, these approaches can help you not just preserve but potentially grow your wealth during uncertain times. I'd love to hear which of these strategies resonates most with you, or if you're using different approaches to protect and grow your wealth in today's economic environment. Drop your thoughts in the comments below, and if you found this discussion valuable, please hit that like button and subscribe to the channel for more insights on building wealth in any market conditions. Remember, in the world of investing, staying informed and adaptable is your greatest advantage. Thanks for joining me today, and I'll see you in the next video.